Goldman Sachs Group Inc. strategists maintain a positive outlook on Chinese stocks despite a sharp market downturn. They project those key benchmarks will increase by approximately 20% by the end of the year. Led by Kinger Lau, strategists remain overweight on both onshore and offshore Chinese shares, citing a favorable risk-reward ratio. In a note dated Sunday, they wrote that sentiment and liquidity may improve toward the end of the first quarter of 2025 due to greater clarity on tariffs and policies. The MSCI China Index entered a bear market last week, while the CSI 300 Index fell over 5% in the first 7 trading sessions of 2025. This marks the worst start to a year for the CSY 300 Index since 2016. Goldman advises investors to focus on government consumption proxies and emerging market exporters that stand to gain from a weaker yuan. They also recommend selecting technology and infrastructure stocks, noting that shareholder returns should remain strong amid record-high cash distributions and declining domestic interest rates. The strategists retain an overweight position on online retail, media, and healthcare stocks, while upgrading consumer services shares to overweight. HSBC Holdings plc shares a similarly optimistic view, highlighting positive policy signals from mainland China and an improved economic outlook. In November, Goldman had forecast a 20% rise in Chinese stocks over the following 12 months, driven by increased government measures to support the economy. The MSCI China Index has dropped by about 10% due to investor concerns over slowing growth, falling producer prices, and potential new U.S. tariffs. HSBC Holdings plc is becoming more bullish on Chinese stocks listed in Hong Kong, citing them as beneficiaries of supportive policy signals and a brighter domestic economic outlook. They increased their year-end target for the index from 8,610 to 8,800. HSBC upgraded Hong Kong stocks from neutral to overweight, while downgrading India's to neutral. These rating changes come amid concerns about rising geopolitical tensions due to Donald Trump's return and his pledge to impose higher tariffs. The broader MSCI China Index has fallen 19% from its October peak and is approaching bear market territory.